or people who want to borrow it. So any healthy financial system, right, helps in the formation of capital or helps in the formation of required money and meet the short-term and long-term capital needs of people or of individuals for their household requirements, for their business requirements, and for their government requirements. It is very, very important. Now, whenever we are talking about the financial systems, it is very important to understand that it comprises of various institutions, various markets, various services, and various players that are existing in the market, right? You are just transferring this money from those who have it in excess to those who need it or to those who require it. Now, whenever we are talking about a financial system is something which allows exchange of, a financial system is a system which allows exchange of money or exchange of funds between these market participants. Like there are several market participants like lenders, investors, borrowers, right? They want money. So money is transferred to those lenders, investors, and borrowers in financial system. So financial system can operate at a national level, that is at a country level, or a financial system can be operated at a global level also. Wherever possible, you can operate. Now, whenever you're talking about a financial system consists of complex and closely related services of any financial related services, any financial related markets, any financial related institutions, which intend or which wants to provide an efficient or a regular linkage between savers, right? And savers and those who need that money or those who invest that money in economic activity. Such kind of system is called as a financial system. Now, there's a famous definition quoted by Prasanna Chandra, which says that financial system consists of a various of institutions, markets, and instruments related in a systematic manner. It comprises, whenever you're talking about a financial system, it comprises of, or it consists of, it has an elements which include institutions, markets, and instruments which are used in a systematic manner or which are related in a systematic manner. It is a system which provides a means for transforming the savings into investments, is what Prasanna Chandra says. Now, there are several functions of financial systems. Whenever we talk about the functions of financial system, the financial system of any country performs various valuable functions. Like for economic growth of the country, it is very, very important that there should be an existing financial system. And this financial system plays a very crucial role for conducting economic activities. Now, what are the various functions that are undertaken in a financial system are? The first one is provision of liquidity, right? Whenever we are talking about the provision of liquidity, the financial system, the major function of a financial system is to provide money or monetary assets for the production of goods and services. That is, whenever money is required in the market, there should not be any shortage of money for any kind of ventures, right? There should be sufficient cash, money, or other assets which should be readily available to be converted into cash without much loss. So provision of liquidity is one of the important function of financial system. Next comes mobilization of savings. Another important activity or another important function of financial system is to mobilize the savings. That is, whoever has the money, that money should be made available to investment. That money should be made available in the system so that people can use that money in an efficient manner. People can use that money in a proper manner in order to invest them and get a effective result, or in order to get effective returns. It is very, very important. So for mobilizing the savings or for mobilizing the money, the financial intermediaries play a very predominant role for mobilizing the money from savers to investors. Not only that, and the financial system functions, you have something called as a size transformation function, right? The savings of millions of retail investors or the savings of millions of small investors, right? of any small units cannot be uh, fruitful unless and until they are invested. You have to invest it. Then only the savings have certain purpose. The savings have certain reason. So for that purpose, banks and other financial institutions or intermediaries perform this size transformation function, right? What do? Is they collect the money. They collect the deposits from small customers and give them as a loan to somebody who wants to make it bigger or to a sizable quantity. This size transformation is very important function of financial management, because it is very difficult to collect money from those small investors if there are no banks or financial intermediaries in between. Then we have something called as a maturity transformation function. Another important function of maturity transformation function is, see, the financial intermediaries or the banks accept deposits from public, right, which have different maturity periods, right? They have certain maturity preferences, which includes liquidity preference, which includes liquidity preferences, which includes other preferences. So that maturity transformation function is also very important to promote the economic activities. And the last important function of financial system is risk transformation function. Now, whenever you're talking about risk transformation function, see, most of the small investors, whether you take the households, whether you take the small business organizations, or whether you take the individuals, they are risk averse with their small holding of savings. That is, they don't want to, or they hesitate to invest directly in stock market. So this financial intermediaries collect something called as savings from these individuals, pool them, and invest them in diversified portfolios like mutual funds, right? They spread they don't invest in only one investment avenue. They invest it in different units, right? Because they have a very good knowledge or very good expertise of how to invest in diversified portfolios, so that the risk of the individuals can be reduced and efficiency can be achieved. So these financial intermediaries act as a risk transforming bodies to transfer the risk or to mitigate the risk of the small investors by investing it in different portfolios. That is very. So these 5 are considered to be the important functions of financial system. Next comes structure of Indian financial system. See, whenever we are talking about Indian financial system, the financial structure talks about the different elements that are present in financial system. See, if you're talking about Indian financial system, you have a formal financial system, which includes financial institutions, financial markets, financial instruments, and financial services. You have 4 elements of formal Indian financial system, that is institutions, markets, instruments, and services. But along with formal, there exists something called as an informal informal financial system. Whenever you're talking about the informal financial system, the informal financial system consists of individuals, money lenders, group of people who are operating funds, partnership companies, local brokers, pawn brokers, non-banking financial intermediaries, rich finance, investment or chit funds. All these comprises of informal financial system. So Indian financial system is broadly classified into 2 categories. One of it, you call it as a formal financial system, or you can call it as an organized financial system. The second one is an informal financial system or an unorganized financial system. Formal consists of these 4 things, that is institutions, markets, instruments, and financial services, whereas informal consists of all these, that is individuals, money lenders, pawnbrokers, chit fund managers, and all those things are the people who comprises of individual system. Now, there is a diagrammatic representation of what are the components of Indian financial system. See, I told you organized. We are only talking about an organized one. In organized one, I told you you have 4 major things: institutions, markets, instruments, and services. In institutions, you have banking institutions and non-banking institutions. In markets, you have primary market, secondary market, that is money market and capital market. In instruments, you have short-term instruments, you have long-term instruments. In financial services, we have something called as fund-based companies, fee-based companies, or fund-based services and fee-based services. Now we will learn about in detail each and every type of component that exists in Indian financial system. See, first we are talking about how the classification of institutions is done. See, the first one in Indian financial system, the major role played is by the financial institutions. Now, what are these financial institutions? Financial institutions are the participants in financial markets. See, there are business organizations dealing with money. There are business organizations dealing with resources. What do? They collect the resources by accepting the deposits. See, whenever you're talking about financial institutions, most of the times we talk about banking and non-banking corporations. What do? Is they collect the deposits from the individuals, or they collect the deposits from the individuals and lend them to traders, or lend them to somebody who is in need of that money. What do? Is they buy and sell the financial instruments. They generate the financial instruments also as well. They are people who deal with financial assets. What do? They accept deposits, grant loans, and invest in different securities and provide financial services to the community. So whenever you're talking about the financial institutions, they are broadly classified into three types: regulatory and promotional institutions, intermediaries, and non-intermediary institutions. These are the three types of financial institutions that you can classify. Now, whenever we are talking about the regulatory and promotional institutions, under regulatory and promotional institutions, we have regulatory bodies like Reserve Bank of India, Security Exchange Board of India, Insurance Regulatory and Development Authority, Association of Mutual Funds of India. So these are the bodies who make sure that whatever financial activities that are taking place in the country, right, all those are regulated, all those behave, all those institutions or all these parties behave in a specific manner or in a responsible manner. So these regulatory bodies make sure that the system is in place, the financial system continues to work properly, right, and expect the banks, expect the insurance companies, or expect the stock markets to function in a specific manner or in a responsible manner. That is a role of regulatory and promotional institutions. Now, what is the role of intermediaries? Intermediaries are, see, whenever you're talking about intermediaries, mutual funds, commercial banks, any organization or any institution, financial institution, which serves as a link between surplus and deficit units. See, I have excess, I have money, but I don't know where to invest. You know how to invest, but you don't have money. So there is an intermediary party which is acting as a link between both of us. These intermediary parties are called as intermediary institutions. So these intermediary institutions include banking and non-banking financial corporations, right? And see, whenever we are talking about banking, you know, they are the institutions of credits, right? They provide mechanism of payment in the economy, right? They not only supply you credit, but they also create the credit. So in banking sector, we have commercial banks, developmental banks, and cooperative banks. All these are the banking sector institutions. But apart from banking sector, we have something called as non-banking financial corporations also. What is the role of this non-banking financial corporations is, the non-banking financial corporations uh, are, they are just merely what do you call as, they only act as a providers of credit. They don't create the credit, they only act as creditors, which is very, very important. Now there are something called as non-intermediary parties. That is, they are the people who don't as a link between surplus and credit. They don't mobilize the financial resources directly from the people. The only thing is they lend funds. They give you loans, but they don't create the credit. Institutions like LIC, GIC, development institutions, provident funds, pension funds, all these are the examples of intermediary, non-intermediary financial institutions. So this is about financial institutions. So financial institutions comprise of, or financial institutions are divided into three: regulatory and promotory institutions like Reserve Bank of India, I told you, SEBI, You have IRDA. All these are regulatory. Intermediaries are banking and non-banking financial corporations. Non-intermediaries are institutions which don't act as a link like LIC, GIC, pension funds, provident funds. Now, after financial institutions, the next major component or the next major element in financial institution, financial system is financial markets. Now, what are these financial markets? Financial markets are the centers, or financial markets are the arrangements which provide facilities for buying and selling of financial assets or financial claims. See, for example, you have a lot of businesses. You will have, you know, what are the various financial institutions, individuals, governments, right? They trade directly or through brokers and dealers on exchanges. See, financial markets are the markets which connect. Financial markets are the markets which connect one set of individuals or one set of players with the another set of individuals or the another set of players. See, if you want to measure a company's growth in terms of economic efficiency, or if you want to measure a country's economy, it is very, very important. The barometer for measuring this efficiency or the barometer for measuring the country's growth is financial markets. Efficient financial markets are those, right, which help in a speedy economic development, right? They make sure that there is free, these financial markets make sure that there is a free and unrestricted flow of funds and other resources in the financial system. Now, whenever we are talking about the financial markets deal with financial instruments. Financial markets deal with financial securities or services. These are the markets in which you have money as well as monetary related claims, which are very, very important. So, financial markets exist whenever financial transactions take place. Now, whenever we are talking about financial markets are classified in 5 different ways. Classification on the basis of financial claim, that is on the basis of financial claim, financial markets are divided into 2 types, debt markets and equity markets. Now, debt is a market for fixed claims like debt instruments and things like that. Whereas equity market is a financial market of residual claims, which has equity instruments. See, when we are talking about loan related markets, we call it as debt market. When you're talking about residual claims, we are talking about equity market. Not only that, financial markets are classified on the basis of maturity of claims. That is, on how the maturity is happening, or on what terms that the maturity is happening. Based on that, if the financial markets are classified, they are classified into 2 times, money market and capital market. Now, whenever you're talking about money market is a market where only short-term funds are borrowed or lent. That is, when any short-term funds which are borrowed for less than 1 year period of time or 1 year period of time. See, the maturity period is short or the maturity period is less than 1 year, you call it as money market. Whereas if the maturity period is long or if the maturity period is more than 1 year period of time, you call it as capital market, right? The money market is a place where the demand and supply of short-term funds are met. See, I want money. I can return it back in 1 year. I can borrow money from money market. But my requirement is large. That is, I want to buy up a house. I cannot return your money within 1 year. It takes me long time period to return your money. Then you can borrow funds from capital market, right? Capital market usually deals with long-term claims like securities, stocks, which have the maturity period of more than 1 year, right? So if you're talking about short-term funds, you go to money market. If you're talking about long-term funds, you go to capital market. Now, on the basis of origin of claim, you can classify them as primary markets and you can classify them as secondary market. Now, what are these primary markets are? Primary markets are those markets which deal with new securities. That is, primary market is also called as new issue market. These are the markets where securities are issued for the first time, right? Primary markets, securities are issued directly by the companies, right? Primary market is a market where capital formation actually happens when the companies are raising money in the form of shares, when the companies are raising money in the form of debentures directly from the individuals or when they are looking out for a fresh supply of capital, that market is called as primary market. Secondary markets are those markets, right, where it deals with an already existing shares. It is completely opposite of primary market. In primary market, you are raising the share or you are raising the money for the first time directly, whereas secondary markets are those which deal with an already existing securities, right? That is securities which are already issued or securities which are already outstanding. Those kind of markets, when you're dealing with, we call it a security market. Secondary market, usually it consists of stock exchanges, right, where you can buy and sell the shares second hand, not directly from the company. You're dealing the shares in the stock markets, you call it as a secondary market. Apart from that, we have the classification on the basis of structure. On the basis of structure, markets are classified into two types: organized markets and unorganized markets. Organized markets are the markets which are established in a systematic and in a proper manner or a proper structure. They follow certain rules. They are well established. They operate in a systematic manner. You call such kind of markets or organized markets. When people don't follow an orderly manner or people don't follow any rules, such kind of markets are called as unorganized markets. They are very difficult or they're very hard to regulate, these markets which are unorganized. Now, when you're talking about the classification on the basis of timing of delivery, we have two types of classifications: cash spot market, right? That means where buying and selling of commodities or stock happen only for cash and delivery happens immediately. You call such kind of market as cash market or spot market. See, whatever market you go for buying of vegetables or whatever market you go for buying of provisions, that kind of market is called as cash market because you immediately transfer the money, you immediately get the goods delivered. Such kind of markets are called as cash markets or spot markets. But there's something called as forward or futures market, right, where participants buy and sell the commodities of the goods which are currently not available, but they will be available in the future time. That you are making a predetermined purchases or you are making a predetermined delivery of the goods which are not existence, right? They will come into existence in the future. Now, there is another type of classification called as classification on the basis of financial markets. You have something called as a foreign exchange market. You have something called as a derivative markets, right? A market where you can deal with another country's currency, where you can purchase and sell foreign currencies. You call such kind of market as foreign exchange market, right? See, foreign exchange is something to do with other countries' money. So whenever you're dealing with other countries' financial structures, or whenever you're dealing with other countries' currencies, we call such kind of markets as financial markets. Whenever you're dealing with your country's currency, whenever other country is dealing with your country currency, we call it as foreign exchange currency. So whenever you're buying and selling other countries' currencies, we call it as foreign exchange currency. There is something called as derivative currency, right? They are the modern financial instruments which are used for mitigating or hedging the risk. Now, what is derivatives? Derivatives are the assets which derive their value from the underlying asset. There is something called as a common place where you can determine the value of your asset by the asset which is underlying under it. We call such kind of markets as derivative markets. Now, after markets, the next classification is financial instruments or financial securities. Whenever we are talking about, see, we have learned about financial institutions. There we had 3 classifications. We have learned about financial markets. There we had 5 different classifications of markets. The next component in financial system is financial securities or financial instruments. The financial instruments are the financial assets, securities, and claims, right? You can view them as financial assets and financial liabilities. Now, what are financial assets? Financial assets are the claims for receiving a sum of money in the future time period, or it is a asset which represents the periodic receipt of interest or periodic receipt of dividend, right? whereas financial liabilities are complete opposite of it. Financial liabilities are the promise to pay a prospective income or wealth to others because you have borrowed money from them or because you have borrowed financial assets from them. Now, whenever we are talking about financial assets and liabilities, financial assets and liabilities arise or come into picture from the basic process of financing. See, some of the financial instruments can be traded or are transferable, whereas the other financial instruments are non-tradable or non-transferable. See, for example, financial assets like deposits with bank or deposits with companies, post office, insurance policies, they are not transferable, they're not tradable. Whereas securities like equity shares, debentures, government securities, and bonds are tradable and transferable. So, hence, what is tradable, what is transferable under financial securities and instruments, people should have a clear understanding of that. Whenever we are talking about the financial instruments, financial instruments are markets. When you raise money through capital markets or when you raise money through capital, we call such kind of raising of money through capital as capital market instruments, right? Now, what are these capital market instruments? Yes, they include equity shares, they include preference shares, they include debentures, they include warranties, they include bonds, right? These are the securities, just like whenever I told you, whenever you're talking about capital markets, the maturity period is more than 1 year. If it is less than 1 year, we call it money market. If it is more than 1 year, we call it as capital market. So, because these securities have a maturity period of more than 1 year, the financial instruments are used for raising money and supplying money, right? Right, are called capital markets. And if it is less than 1 year, we call it as money markets. See, the examples of money markets are treasure bills, commercial papers, certificate of deposits, right? Mutual funds, etc. Now, whenever we are talking about financial securities, it is very, very important, or financial instruments, it is very, very important that you find this financial instrument. You can identify the financial instruments. You can name them as short term, long term, and medium term. Anything which is less than 1 year, you call it as short term. 1 to 3 years, you call it as medium term. Anything which is more than 3 to 5 years, we call it as long term financial instruments. Now, these financial instruments have the characteristic features of liquidity. That is, you can easily convert them into cash. They are marketable. That is, you can easily sell them in the market. They have a collateral value. That is, you can use these financial instruments as collateral securities, right? Or collateral, you can pledge them for getting loans. They are easily transferable from one person to other person. They have a maturity period ranging from short term, medium term to long term. They include the cost like brokerage commission, security transaction tax, which are called as transaction costs, and they carry a certain amount of risk and return upon themselves. This is about financial securities. Next comes financial services. Now, whenever we are talking about financial services, see, whenever we are talking about financial services are the processes, right? Financial services are the processes by which consumers and business acquire financial goods. That is, whenever we are talking about financial services, it is professional services which involve investment, which involve lending, which involve management of money and assets, which involve management of money and assets. See, for example, financial services are provided by a financial institution called bank. What financial services does it provide? It accepts money and transfers money to those who need it, right? It includes accounts, which include debit cards, credit cards, checks, electronic fund transfers, and things like that. So there are a wide range of financial services which are existing in the market. These financial services can either be fund-based financial services or fee-based financial services. See, the categorization of financial services is like that. It can be a fund-based financial service. It can be a fee-based financial service. Now, how does a fund-based financial service look like? See, a fund-based financial service is a service. One second. A fund-based financial service is a service, right? Which, um, whenever you're talking about a fund-based financial service, they involve funding of funding which is provided by a financial service provider. See, for example, you are acquiring an asset by lease or hire purchase, right? Leasing, hire purchasing, bill discounting, venture financing, housing financing, factoring, insurance, everything comes under fund-based financial services. That is, you are providing the fund in order to acquire the asset, right? By using any of this system or by using any of these things. See, you can use bill discounting, you can use venture capital, you can use factoring, you can use insurance, right? Any of these services can be used, right? In order to acquire the asset, we call it fund-based financial service. On the other hand, we have certain services which are fee-based, like you provide, there are what do you call as portfolio managers who will suggest you, who will advise you to invest in which kind of services. Like the fee-based services include merchant banking, credit rating agencies, stockbrokers, right? Mergers, issue management, all these are the fee-based services. Now, whenever we are talking about the functions and importance of financial services, it is very, very important to understand the importance of financial services. Now, what are the important functions of financial services are? See, whenever you're talking about the financial services provide a wide range of services to meet the needs of the customers, to meet the needs of the institutions, and to meet the needs of the corporate world. So, what kind of services that they provide for the what do you call as orderly development of economy is promotion of savings. Financial services mobilize the savings of people and give it to those people who need it. So it promotes savings and provides them in the form of loans to large number of people so that they can earn return and they collect the fees for such promotion of service. The next important function that a financial service provides is capital formation. Financial service uh, facilitates capital formation, right? By providing a lot of intermediary services. See, capital formation is only possible because of financial services provided by various intermediary parties. So capital formation is also one of the important function of financial services. Not only that, effective utilization of resources, whether the resources are utilized properly or not, right? Or whether services like factoring, securitization, credit rating, right? All these services are done properly or not, only financial services can tell you, right? So it is very, very important to utilize the funds properly because these are something which can give you efficient results. So that is also taken care by financial services. Financial service industry promotes liquidity. Why? How can it promote liquidity? Is it allocates and reallocates the savings in various economic activities, which will help you to convert financial assets into cash immediately. See, for example, bill discounting, parking of short-term funds in money market, factoring, all these will help you out in converting your money into cash immediately. Financial intermediation is also one of the important function or importance of financial services. See, financial services perform intermediary function between savers and investors. They collect money from those who have it and give it to those who need it. Not only that, creation of employment opportunities is also possible with financial services. That is, the financial service industry creates employment opportunities for those who are directly employed in financial sectors. And not only for those, indirectly, it will help millions of others, right, who are facilitating this financial services. All those people get employed across the world because of the financial services. Not only that, financial services promote something called as international trade. That is, they promote trade domestically also. They promote the trade in a foreign country also. So featuring factoring companies promote export of goods to foreign markets, or they also help in sale of products or services in the domestic markets also. Not only that, insurance and banking facilities are also supported to trade activities using financial services. Financial services play a very crucial role in increasing the standards of living of individuals. See, it is very, very important uh, if you want to go for economic development of a country, people should improve their standard of living. They have to generate employment opportunities. Their purchasing power should be enabled. They should be able to enjoy the benefits of luxury items or quality items. This is how the standard of living improves. So living standards must be enhanced, or living standards must be increased in financial using financial services. And the last one is economic growth. See, it is very, very important that by rendering all the functions, the financial services should contribute towards the growth of country, should contribute towards the growth of economic development of country. Next, classification of financial services. See, whenever we are talking about financial services, the financial services are some economic services which are provided by the finance industry. That is, they provide a broad range of businesses that manage money, including banks, credit capital, insurance companies, accounting companies, consumer finance companies, right? All these are the companies which provide financial services. Therefore, financial services can be classified in various ways. One way of classify them is rendering services based upon the institutions, right? Which are rendering services like commercial banking services, investment banking services, financial exchange services, investment services, insurance services, financial planning services, etc. The other way of classifying them is classifying them on the basis of services rendered, such as on the basis of services rendered, you can classify them as fund-based companies and fee-based companies. I told you, fund-based companies are the companies which include underwriting, housing finance, bill discounting, equipment leasing or lease financing, hire purchasing, venture capital, insurance services, factoring, featuring. All these are fund-based services. Fee-based services are merchant banking, credit rating, advisory services, capital restructuring services, debenture services. All these are the fee-based services. Now, there are a lot of challenges which are faced by financial service companies. There are major challenges which are faced by finance-based companies. What are these challenges is, the first important challenge to a financial service is lack of qualified persons. See, financial service sector is a sector which requires a lot of financial creativity because they poses a lot of challenges. So there is a dearth of qualified and trained people in financial services, which is the major hindrance, major hindrance for economic growth or economic development. So the biggest challenge with financial services is the growth is not happening properly due to lack of qualified persons. That is one biggest hindrance. The second biggest challenge to financial services is lack of investors. Financial products and instruments are of no use if the investors are not aware of the advantages, if the investors are not aware of the products and instruments that are available in the financial markets. Therefore, the financial intermediaries should play an important role to educate the investors about the advantages of innovative instruments, right? By conducting seminars, by conducting workshops, by conducting advertisement. It is very, very important to investors to see, apart from traditional financial investment avenues, there are some modern investment avenues. There are some innovative instruments like SIPs, you have mutual funds, you have derivatives market, future markets. So people should be encouraged to invest in those kind of companies by creating awareness through workshops, seminars, and things like that. Next is lack of transparency. The entire financial system lacks transparency. That is, the financial systems are not functioning properly. There is no clear mechanism. There is no clear mechanism through which the financial markets are functioning. If things are not happening in a transparent manner, which is one of the important deficiency, or which is one of the important drawback of the financial system. See, whenever we are talking about the financial system has a lot of disturbances in terms of lack of efficiency, lack of transparency. People are not transparent enough. People are keeping their accounts secretive. People are keeping their accounts, what do you call as accounts orthodox or confidential. Lack of transparency is also leading to what do you call as lack of challenges in financial service sector. Lack of specialization. Each financial intermediary deals in multiple services, right? When you are dealing with multiple things, you cannot when you are dealing with multiple things, you cannot deal with one thing properly. You cannot learn one thing properly. So it is very, very important to understand that financial, there should be a specialization that you should learn upon. There should be a specialization that you should be working upon, right? In order to become an expert into things. Lack of data. People are not spending much time on research. There's no proper data available, which is also turning out as one of the biggest challenge to financial sector. Now, the next thing you need to learn in financial system is financial sector environment. See, whenever we are talking about the financial sector environment, the financial sector, Indian financial sector is highly diverse because it is undergoing a rapid expansion, both in terms of strong existing financial service firms and new markets or new companies entering into the market, right? See, whenever you're talking about Indian financial sector, it comprises of a lot of institutions like commercial banks. It comprises of a lot of institutions like insurance companies, non-banking financial corporations, cooperative societies, pension funds, mutual funds, and other financial institutions. So a well financial sector is one which can go in a long way in facilitating and enhancing the economic development. So therefore, financial sector development plays a very important role in economic development, right? It is something which promotes capital formation or capital accumulation. It takes this technological process into consideration by increasing the savings rate or mobilizing those savings or pooling those savings and producing information whenever required. So Indian financial sector or Indian financial environment provides a lot of scope for development. Now, whenever we are talking about the financial sector of Indian economy, it has a very great or it has a very big history. See, the development of companies, any country's financial markets is one of its key priority or one of its key significant thing, right? The development can be classified into three stages. See, if you're talking about Indian financial markets or Indian financial sector, the development happened in three stages. One is bank oriented sector. In this stage, banks and other financial institutions played a very major role in capital formation. There is something called as early capital stage, which talks about issue of equities, issue of debentures, which have taken over the banks in capital formation. And the third one is highly oriented capital structure, capital stage, right? The capital market became the key sources of long-term financing. They have taken over banks, they have taken over equity and debentures market in order to create the structure. Now, whenever you're talking about Indian financial sector, the story of Indian financial sector post-independence portrayed that there are three different phases in the development of Indian financial sector. It is phased as the first phase spinning from 1950 to 1960, right? The second phase spins between 1970 to 1980s, and the third phase spins the rule between 1990s till date. Now, what is the Indian financial sector growth in these three phases is the first phase, that is the decade between 1950 to 60s there was a limited access to finance. There were large number of bank failures, right? Nationalization has taken place on 20th July 1969, and by 1986 more banks have been nationalized. So this is an era. This is a phase in which banking sector ruled the Indian financial sector. Government wanted to take over the control of this sector because the major number of deposits or the country's more than half 50% of the country's capital was in the hands of banking sector. So the banking sector was on its peak, right? When you're talking about this phase, right? Regional rural banks were established, insurance companies were established, financial institutions were developed in that phase in order to increase the capital formation. The next, that was between 1950 to 1990s. The next phase was from 1990s to till date, right? Structural reforms were initiated in the year 1990s, right? A committee called Narasimhan Committee was formed in order to evaluate the banking sector reforms. There were not only reforms in banking sector, there were reforms in several other areas, financial markets, transparency, financial sector, right? Auctions, convertibility. There were major reforms happening in equity market. There were major reforms happening in financial markets, which was very, very important. So these reforms had their impact on, there are several institutions on which reforms were planned, like there were reforms in terms of banking sector. There were reforms in terms of tax. There were reforms in terms of foreign exchange reserves. There were reforms in insurance sector. There were reforms in non-banking financial corporations. There were reforms in capital markets. There were reforms in the other sectors also, which was very, very important. See, the present scenario is today banking sectors are going for mergers and acquisitions. Most of the public sector banks, State Bank of India has been merged. The 7 subsidiary banks of State Bank of India got merged up into State Bank of India. So there are a lot of mergers that are taking place, right? There are a lot of technological changes that are taking place in banking sector. Fintech companies, financial technology company reforms are happening in banking sector. So today the Indian financial sector has a much more growth. It is not only comprising of banking sector, it comprises of several other things also when it comes to banking sector. Now, there are a lot of challenges that are faced by Indian financial sector. For example, the legal framework available in Indian financial sector is very, very weak. This weak legal framework is leading to a lot of fraudulent activities. This weak legal sector is bringing a lot of loopholes or pathholes into the Indian financial sector. So taking this weakness in the legal framework, people are taking undue advantage of Indian financial sector. And there is poor governance. Regulatory bodies are not governing, or the rules of regulatory bodies are not stringent enough to identify the loopholes or to identify the root causes of financial sector. That is turning out to be the biggest challenge to Indian financial sector. There is lack of transparency. Indian financial sector is undergoing issues relating to transparency. That is, the transparency issues are not taken into consideration. Accounts are not properly maintained. Secretive accounts are maintained, or people are not disclosing their information properly. There is lack of transparency when it comes to accounts in Indian, in what do you call as Indian financial sector. Not only that, there is a challenge in terms of data quality also. That is, the data quality is not maintained properly, right? The information that is provided is not up to the mark. The information that is provided is not proper, right? Which is leading to what do you call as quality of data, degrading quality of data. And one biggest challenge with Indian financial sector is mismatch of assets and liabilities. The assets and liabilities are not matching properly. The assets and liabilities are, there is a lot of variation in assets and liabilities. There's a lot of variations in terms of assets and liabilities when it comes to their efficiency displaying. right? There's a lot of variation to that. That is one of the important aspect of there's lot more importance that is given to that. Now, so you will explain all these things. You will explain about the financial institutions. You will explain about the financial market. Not only that, you will make sure role of financial markets, what is the role of financial instruments, and what is the role of financial services in Indian financial sector is very, very important in order to determine the economic growth of a country, or in order to determine the economic role of the country. It is very, very important to determine all these things, right? By this, I end the class for today. Thank you. If anybody has any queries or if anybody has any questions, you can post me. So if there are no queries and no issues, thank you. Thank you.